Welcome everyone, and thank you for joining us today on our year-end tax planning presentation for 30 June 2021. My name is Alexis Kokinos and I'm a partner at Pitcher Partners in the Tax Advisory Group. I'm joined today by Peter Gillies, a director of our Tax Advisory Group, and together we're presenting on year-end tax planning. We're both presenting from home using our virtual Pitcher Partners backgrounds, because we just missed being at work today, so we hopefully are looking like we're presenting from our office. Today we're discussing a number of tax planning opportunities and requirements for this 30 June 2021. Given that we only have 1 hour to present this session is just limited to a number of the critical items that we believe you should be considering for your year-end tax planning for this 30 June. Just as some general housekeeping, if you could please use the Q&A box if you have any questions that you'd like to raise during the seminar. We'll aim to try and answer those questions at the end of the session if there's time that permits. Otherwise, we'll try to get back to you on those questions. There'll be a link to the slides and recording that we'll send out within 3 business days after this session. As in previous years, Pitcher Partners will be releasing its comprehensive guide to its year-end tax planning, which spans over around 60 pages and includes a lot of specialty topics such as individuals, trusts, companies, managed funds, investment entities, and international tax. We'll aim to be releasing our guide publicly by the end of next week, which is a lot earlier than normal. And all the items that we're discussing today will be contained in that guide. If you'd like a copy of the guide, please contact your usual PP contact. We'll also be sending out a bulletin that provides links on how to use the guide once it's released. So moving into the session today, what we're going to cover is 4 main areas. We're going to cover just some of our common tax planning techniques that are bread and butter, what you need to do, what we think everyone needs to do for this 30 June. We'll also be talking about trusts and some of the key issues that you need to be aware of when doing your distributions for this 30 June. For companies, again, some of the critical items for companies for 30 June, and we'll talk about individuals and some of their items that they need to consider for 30 June as well. So with that, I'll pass on to Peter to commence with the general considerations.
Thanks, Alexis. Well, as Alexis says, this is a high-level run-through of the sort of common garden variety year-end issues that you would be used to thinking about at this time of the year. So firstly, just to set the scene, in terms of the timing rules for income and deductions for tax purposes, ordinarily business income would be returned on an accruals basis with passive income recognised on a receipts basis. Now, when I say accruals basis, obviously some of you will be familiar with that from an accounting background, but what I mean from a tax background is that in the context of a business, income would be regarded as derived and thus needing to be reported for income tax purposes when the business has done everything that it needs to do in order to be able to earn the income or raise a bill for the income. So under that sort of principle, the timing of the invoice or the timing of receipt of cash on payment of the invoice is not the time of derivation. It's when everything is done that needs to be done in order for the business to be able to bill for its income. From a deductions perspective, the general rule is, and again, this is regardless of whether you are reporting the relevant income on an accruals or receipts basis, the rule is incurred. So has everything been done which results in there being a definitive liability to a quantifiable loss or outgoing? So if it has been incurred, then, as I say, regardless of how you're reporting income, the deduction would be available to you, obviously subject to the ins and outs of the tax law. So one of the things to think about there is review accrued income, accrued expenses, and unearned income as might be reported in draft financial statements for year end, as well as any large transactions that have been recorded this year, and think about whether or not they need to be reported for income tax purposes this year or next year, and indeed whether or not some of those larger transactions are more properly regarded as on capital account and thus deserving of different treatment than normal P&L items. Just then talking about a few of the P&L items, sorry, and I should say P&L for those that are not of an accounting bend, refers to the profit and loss statement. So there might be prepayments that you've got, which will obviously, from an accounting perspective, involve both the profit and loss statement and the balance sheet. So looking at the balance sheet, you'll see that portion of any prepaid expenses that the accountants have picked up and said, shouldn't be recognising that from an accounting perspective as at this year end. It properly relates to next year because the payment relates to the provision of services or goods over a period of time extending beyond 30th of June. The prepayment rules for tax purposes, though, have certain exclusions. So some of those things that the accountants might be deferring recognising as an expense may properly be allowable as a deduction this year. So it's necessary to review those deferred amounts and decide that, yes, they should be deferred, or no, an immediate deduction can be taken. The flip side, obviously, is to make sure that the prepayment rules are being adopted and that what should be deferred is being deferred. Bad debts is another standard item. The critical thing from an income tax perspective is to make sure that a formal decision has been made that the debt, which should be reasonably doubtful from some objective purpose, has been written off. That is, that there is documentation to say we've considered all these, what might be regarded as doubtful debts, and decided that some of them are more doubtful than others, and that we are going to write them off. So a formal record that that decision has been taken that you can provide to the tax office if the question's ever asked. Trading stock, the tax rules provide for a number of options in terms of how trading stock is valued, and the options are cost, market selling value, replacement value, or some lower value if the particular item of trading stock is obsolete or for some other reason is slow moving. Now, from a tax point of view, those options, those various valuation options, can be applied on an item by item basis. And that's item by item, even if they're the same type of trading stock item or same category of trading stock item. You could potentially value an older widget as an obsolete item and at therefore a lower closing value, whereas a more current item of the same nature, similar widget, is still saleable, still able to realise its normal market selling price. So an obsolescence value wouldn't be appropriate or wouldn't necessarily be appropriate. So necessary to review your trading stock values at year end, and obviously the value you choose can result in a greater amount or a lesser amount of taxable income for this year. Bonuses is another common question. So to the extent to which you are providing bonuses for the excellent performance that your staff has given you during the pandemic, then it's critical that the decision to pay the bonus is recorded, that the employer has definitely committed themselves to paying a quantifiable amount to identifiable employees by 30th of June in order to be able to claim the amount of the bonus as a deduction this year. Turning to donations, there's obviously two issues there that you should be focusing on. Firstly, that the donation, if you're claiming it as a donation, is to a deductible gift recipient. If you're claiming it as some sort of advertising expense, then obviously that's not necessarily relevant. But going back to donations, if it is a donation, that the recipient is a deductible gift recipient, and importantly, that the amount of the donation that you're claiming as a tax deduction does not give rise to or increase the amount of a loss. There's a limitation in the tax rules that says a donation cannot be deducted this year if it does result in either of those situations. If that is a risk, the tax rules provide for the ability to spread the donation over up to 4 subsequent years. Now, if you are in the unfortunate position, from a financial perspective anyway, of having a tax loss, then it's necessary to think about the rules governing the extent to which those tax losses can be used. That can become quite complex, a very facts and circumstances particular exercise. There's rules that apply to companies and there's separate rules that apply to trusts. In the case of trusts, let me just say that for those in the audience that are more of an accounting tax background, because clients have raised this with me, that they thought in the context of a trust, it was necessary to make a family trust election in order to be able to use prior year losses. That is certainly one way of making sure you can use the tax losses, but it's not the only way. So there are alternative rules that can allow a loss to be used by a trust, even in the absence of a family trust election. And I say that because the making of a family trust election brings its own consequences, which may not be desirable. Turning then to some issues that have come out of stimulus measures and other integrity provisions introduced over the last year or two. Firstly, rental properties, a common focus area for the tax office, and they've finally got the ear of the Treasury, and they've introduced a couple of sets of provisions that can operate to disallow deductions. So the first on the list was travel expenses. So traveling to inspect or to do anything with a residential rental property is now no longer tax deductible for individuals, trusts, and self-managed superannuation funds, unless the taxpayer is carrying the residential rental property activities amount to the carrying on of a business. And generally, in the case of an individual or a trust, and probably also a self-managed superannuation fund, it would be difficult to argue that rental property activities amount to the carrying on of a business. Not impossible, but difficult. So rental property travel expenses is the first cab off the rank. The second one is a couple of years ago, the tax law was amended to provide that depreciation on fixtures and fittings in a residential rental property at the time of its purchase. So the rules are focused on established dwellings. So if you buy an existing property with fixtures and fittings in it and get one of those quantity surveyors to go out and do you a capital allowance report or a depreciation report, and what they are picking up is all of the fixtures and fittings in the property at the date of purchase, that's largely a waste of exercise from a deductions perspective, because the depreciation on those installed fixtures and fittings is now no longer deductible. Turning to vacant land, the tax law was amended recently to provide that costs, including interest related to holding vacant land, is no longer deductible. So that's vacant land being land on which there is no substantial or permanent structure. And again, there is one further exception where the land itself, the vacant land, is used or available for use in the carrying on of a business by an entity connected in one way or another with the landowning entity. And there's rules in the tax law about what connections are required to establish deductibility in the context of there being a business carried on. Now, importantly, though, the vacant land measure applies to costs incurred after the beginning of the 1919 income year, regardless of when the land was acquired. So even if you've held the land for a decade or more recently incurred costs are now no longer deductible to the extent to which you don't satisfy one or other of the exceptions. The non-compliant payments rules are directed at payments of salary and wages or payments to contractors for services where the PAYG withholding rules are not satisfied. So you'll be familiar with the fact that wages are normally associated with an obligation to deduct tax and remit that to the tax office. If that withholding obligation is not satisfied or the amount withheld is not remitted to the tax office, then the salary and wage amount is now no longer deductible. Similarly, if you're paying a contractor for services and the contractor hasn't provided you with an ABN, or has, and provided you don't have, or has and you have reasonable grounds to believe that the ABN is not authentic, then again, the payment to the contractor is not deductible. But if you have been provided with an ABN and have no reason to doubt its authenticity, then the payment is deductible, even if the ABN registration is not valid.
Peter, just on the
Ooh.
vacant land measures, just one quick.
Hit the wrong button. Sorry about that.
No, that's okay. One quick comment I'll just make is that the number of groups hold land or land bank in SPV trusts. And so this issue about whether you have land sitting in an entity that is just an SPV, hasn't carried on business previously, whether you'll get caught up on those provisions. And Pete mentioned that that you can look at a business of a connected entity. And we just highlight that as part of year-end planning, if you do have those risks, that certain distributions can be made to create connections between entities as well if they aren't otherwise connected. So it's something also to consider as a part of the year-end planning if you have trusts.
Turning then to stimulus measures that some of you may have benefited from over the last 18 months or so. JobKeeper payments and cash flow boost, the first one's on the rank. So JobKeeper payments raised the question of whether, and this is really a beginning of year issue predominantly rather than this financial year end, but one of the issues that was raised back in June 2020 was whether JobKeeper payments for the last JobKeeper reporting periods for that year were accessible in 2020 or more properly accessible in 2021. And as a result of us prompting the tax office, they eventually put onto their website that for that last reporting period, because payment was conditional upon the lodgement of reports in July, that the amounts were properly accessible in the 2021 income tax year. So if you've done that treatment from a tax point of view, it may be that the JobKeeper payments for that last reporting period in the 2020 income tax year were actually reported as income for accounting purposes in the 2021 year. So it's necessary to go back and have a look at what you did with the JobKeeper payments for that last reporting period in 2020 and make sure that it's lined up for purposes of the tax reporting for this year. The cash flow boost is something that you'll also need to pick up and identify because it was made non-assessable, non-exempt. So it's not taxable. So you need to identify what it is and make sure it's not reflected in the calculation of your taxable income. It does have a flow-on implication for the deductibility of certain types of costs. So it might be something that you need to look at. The one type of cost that is not prevented from being deductible, notwithstanding the fact that the cash flow boost is not taxable in the simple sense, is tax advice fees. So if you've been charged any fees in relation to advice around the cash flow boost, that's a valid deduction for 2021. The flow-on issue for JobKeeper payments, particularly JobKeeper payments for business participants, because they wouldn't have otherwise been paid out as wages, and for cash flow boost, is how those amounts are flowed out to the owners of the various entities that might have received them. Companies not so difficult could come out as a dividend and may be unfranked to the extent to which they are largely comprising of cash flow boost, which would have top-up tax implications for the shareholders. More of a problem for unit trusts flowing these sorts of amounts out, which might result in a difference between the accounting income of the unit holder compared to the taxable income of the unit holder, can trigger a change or an adjustment to the CGT cost base in the units. And if that amount is nil, can result in a taxable capital gain arising on flowing out these differences between taxable income and accounting income. Complex issue. Certainly, if that's something of concern to you, you'll need to have a chat to your usual PP representative. Turning to depreciation, this should be a classic garden variety year-end consideration to review the fixed asset schedules, make sure assets that have been scrapped have been written out of the schedules, to review what's there, and if something can be scrapped, scrap it before year end and claim the deduction this year. More generally, and particularly as a result of the stimulus measures, there's a need to look at your capital expenditure plans and how the measures that have been announced over the last 18 months or so impact the deductibility of what you've spent or what you're planning to spend. So just turning to the temporary full expensing measure, which is the last of the concessions or the stimulus measures that was introduced in the deferred budget from the 6th of October 2020. This provides for businesses with an aggregated turnover of less than $5 billion the ability to claim an immediate deduction, regardless of the cost, of depreciable assets that were first used or installed ready for use on or after the 6th of October 2020. So it's an immediate deduction, no limit on the cost base, so long as you're under that aggregated turnover threshold. It obviously extends into next financial year as a result of the budget announcements. But for this year, we're obviously looking at assets used or installed for use after 6th of October 2020 and before 30 June 2021. Now, again, as a result of some representations that we made to Treasury, entities have been provided with a choice to opt out of the full expensing measure. You might want to do that if, for example, it would otherwise throw you into a loss, which may raise other issues relating to a loss carryback measure that we'll talk about in a little while, or you might want to opt out of it because the particular asset you're concerned with has a relatively short effective life, and you're not wanting the full cost to be written off in this year versus 2 or 3 years. But you might want to opt in, and I should say that the choice to opt in or out is on an asset by asset basis. You might want to choose to allow a longer term asset to be picked up by these rules, so that rather than writing it off over 10 or 20 years or 100 years in the case of artwork, you claim an immediate deduction in this year. Now, there is a need to be careful about opting out of the temporary full expensing, particularly for assets acquired before 31 December 2020, prior to temporary full expensing being effectively the full game for depreciable assets. There were measures that didn't provide for an opt-out. We've referred to them in earlier presentations that you may have attended during the course of last year as the instant asset write-off. The rules are complex, various exclusions, different thresholds, not something that we can go into in any detail today. But again, if you're talking about assets acquired before 31 December 2020, opting out of TFE because it's after the 6th of October may still mean that you're going to get an immediate deduction under these alternative rules. And again, claiming the full immediate deduction might throw up a difference between the accounting and tax result for a unit trust. Again, a watch out in terms of that CGT cost base adjustment potential capital gains event, which technically is referred to as CGT event E4 for those who are interested. Back to you, sir.
Thank you, Peter. So our next topic is on trusts, and it's safe to say that the ATO are becoming more hardline around trusts and the operation of trusts, and I'll talk about a few items within this section. And if you are going through a top 500 or 5,000 review from the ATO, their first questions are for taxpayers to provide all the trust deeds, all of the distribution minutes and resolutions that have been made, and they do go through a review of that and compare that to tax returns, etc. So ensuring that your resolutions and distribution minutes are correct is critically important for any income year. The critical things that you need to be doing, as you would do in any year, is going through your trust deed, making sure you understand what the income is of the trust, whether it's taxable income, whether it's accounting profit, whether it's something else, understanding who the beneficiaries are, whether you can actually nominate the beneficiary, whether it's an excluded beneficiary, because there can be preclusions from distributing to certain entities from the trust. especially in some new trust deeds that preclude foreign beneficiaries for various state tax issues. So understanding your trust deed is absolutely essential. But then secondly, evidencing that you have actually made resolutions to distribute income to a place is critical as well. And although minutes need to be put in place, a minute only obviously records what has happened at a certain time. So providing evidence is always important. So if you can hold a meeting and document exactly what you intended to do, that is the critical document that you would come back to once drafting your minutes, or if you have to revisit what actually happened afterwards, if there's ever a dispute. So ensure you are holding those year-end planning meetings to get your resolutions correct. One of the things that is often overlooked is that if you're distributing to a new entity, that there is a TFN disclosure requirement. So if you distribute to an entity that hasn't disclosed its TFN to you, there's a 47% withholding obligation when you create the present entitlement. So if you create new entities, make sure you've already applied for TFNs. Make sure that you have documents showing that the TFN's being disclosed from one entity to the other entity. So you pass through that, and that you complete your TFN disclosure reports as well that need to be lodged with the ATO. The last item I've got on there is just taking care on proposed distributions to loss entities. There are a lot of what we call income injection rules, which can be especially triggered if there's large timing differences from a trust. So if a trust does have differences between the accounting profit and taxable income, and so there's a large taxable income over and above the accounting distribution, and the taxable income is then sent to a loss company that utilize all the losses, there are some income injection rules in companies that effectively can deny the losses where the amount of taxable income doesn't result in a economic benefit to the shareholders. So it is a watch out provision that the ATO is focusing more on. You can obviously get around that by trying to ensure your income distribution, the cash distribution, is effectively similar to the tax distribution going to the corporate entity. Just in terms of distributions within a family group, one of the key things that we have is making family trust elections. If you do have a risk of the nominated person not being here after 30 June, then it is ideal to ensure that you have completed a family trust election now. It can only be signed after 30 June, so 1 July, it can be signed, but the sooner it can be signed, the easier it is to get the entity in the group. If subsequently there is a deceased person, they are unable to sign the document and have the entity join the family group, which can cause a whole host of issues. So identifying new entities in the group early is really important, and you can get those documents completed now as much as possible. So one area I'm going to talk to very quickly is section 100A around trust distributions. For about 18 months now, the ATO has had on its consultation website that it's been looking at providing a ruling on section 100A. The ATO had previously provided a fact sheet on how it would seek to apply 100A, and that was issued in July 2014. So 100A is loosely labeled reimbursement agreements, and what the provision can apply to is where a trust distributes some income to a person, and then under an agreement it provides a benefit, some kind of benefit to another person, and there is a tax benefit associated with that arrangement, then the ATO can seek to apply 100A. Now there's an exclusion for what they otherwise term an ordinary family or commercial dealing. However, the ATO have generally taken a very narrow view of what that means historically. So in an example that the ATO has in their fact sheet they released in 2014, they had some distributions to some adult children beneficiary who got to access the tax-free thresholds and some of the lower marginal rates. And then the cash was then lent out to the adult parent beneficiaries. And the ATO said in their view, they would seek to apply 100A. Similarly, if that was gifted to those individuals, or if the amount of the unpaid entitlement from the children was gifted to the adult parent beneficiaries, the ATO would seek to apply 100A. The consequence of section 100A is quite severe. It means that the present entitlement is essentially disregarded and the trustee is assessed at 47% on the distribution. Not only that, the ATO has an unlimited amendment period on this provision, so it can go back to effectively 1979 on this provision and open up any assessments that it otherwise has. So it is quite a strong provision that the ATO could seek to apply. In the same fact sheet that the ATO released in 2014, I'll move to the next slide. They had an example 4, where they had a similar distribution to the family members, but the money was then lent out to other beneficiaries at a commercial interest rate. And in that fact sheet, they said they wouldn't seek to apply Section 100A under that type of arrangement. Now, whether the ATO's view changes on that in the future is not yet known, but under the fact sheet, they've currently said that they wouldn't seek to apply it on that. They've also made mention that if there's unpaid entitlements to corporate beneficiaries and a trust use that money in a working capital of a business, they wouldn't seek to apply 100A in that case either. But they're silent on when you use the unpaid entitlement for other purposes as to whether they would seek to apply 100A. So for this 30 June, given that we're expecting the ATO to finalise their ruling and release something next year, we do stress care needs to be taken on distributions. If you are distributing to other family members and all you're intending to do is put that to their unpaid entitlement account and not pay the money over to them or gift their unpaid entitlements, or have amounts paid to a family bank account where the money really just goes to the parents and there's no tracking to any types of costs associated with those other beneficiaries, then you'll place yourself at a higher risk of the ATO potentially seeking to apply this provision. So absolutely, definitely, this is one critical item to take into consideration when planning your distributions for this 30 June. Another critical item for trusts is around the treatment of unpaid entitlements to a corporate beneficiary under Division 7A. So ATO in 2010 had released a ruling saying that if you distribute an amount to a corporate and you left that unpaid, then that could become a loan. But if you placed it under a sub-trust arrangement that was basically holding the money for the benefit of the company, either under a 7-year arrangement or a 10-year arrangement at interest, then in those circumstances, the ATO was not going to seek to treat that amount as a loan from the company to the trust. If it was a loan, then it could be treated as an unfranked dividend potentially, and could essentially result in substantial top-up tax. So the ATO has had that view since 2010, and essentially there has been some government announcements suggesting that treatment would likely go away going forward. And there's been some uncertainty as to whether the ATO would continue the treatment for sub-trust arrangements. The ATO had issued PCG 2017/13 previously, and what they had done in that is they covered all of these sub-trust arrangements up to 2020, where they said under that they would continue to effectively respect those arrangements. And when they came to an end, either the 7-year had passed or the 10-year arrangement effectively, which will be passing this year, they would allow you to refinance those unpaid entitlements on Division 7A terms. So that was up to the year 30 June 2020. And now we're coming up to 30 June 2021, and we have a number of other sub-trust arrangements that are effectively also closing out. We expect the ATO to hopefully re-allow that practice or extend this PCG so that you can again refinance those unpaid entitlements back into 7-year arrangements. However, the ATO has not been clear about whether new unpaid entitlements this year would also be allowed to be refinanced in the future under sub-trust arrangements. We'd expect further guidance to come out on this after 30 June. In our experience, that if you are using sub-trusts and you are looking to take to use the opportunity of sub-trusts in terms of funding your activities, then the best thing to do is, if you are doing distributions for this 30 June, is to leave the option open for yourself. Your resolutions, if they create loan accounts and take them to loans, then obviously the option won't be there to create sub-trusts. So leaving the present entitlement just credited to the benefit of the company will give you the option, at least after 30 June, to consider what the ATO say on this issue. And if they do provide an extension for sub-trusts for this 30 June as well, then you might be able to take advantage of that Obviously, it's a much lower funding cost if you're using that money in the business, in terms you don't need to pay annual dividends to cover minimum loan repayments. Another key issue around trusts is where there are multiple trusts in a group and companies in the group, and where you have a company, in this example, which we've got on the screen, where you have a management company that's incurring a lot of expenses, but it's not charging for those expenses to other entities. Instead, it's receiving trust distributions from other entities in the group. So the trust distributions, which are taxable, are being used by the company to offset its losses on those expenses. The ATO issued a tax determination TD 2018/9, which essentially said those expenses weren't being incurred to earn income, unless the management entity in this case was made presently entitled to all of the income well before it incurred those expenses. So in a general sense, they would say that those would be all non-deductible, but the income distributed to the company would be all taxable. So it could result in quite a substantial amount of tax being paid. The easiest solution in this example would have been to take the management entity and to charge an appropriate management fee down to the trusts. And in order for that to happen, if you identify this issue, you would need to put in place a management agreement between the management entity and the trusts, and you would need to ensure that you've agreed to those charges before 30 June. The ATO have won cases where those charges have occurred after 30 June, and there was no evidence to prove that the management charges were agreed to prior to 30 June. And as such, the amount of the charge for management entity was held not to be valid. So now that we've got a month to consider this issue, if you do have this type of structure, it is pretty critical to identify that and have the management entity at least charge all of those costs that it's seeking to claim a deduction on over to those other entities. Just the last point on this, the ATO did run a case last year called Chadbourne at the AAT, and effectively this issue, it involved an individual that was incurring expenses rather than a management entity, but the individual was denied all deductions on this principle. So it is one that has been recently heard, and the ATO will take up on a review or in terms of considering this issue.
Back to me.
Thanks.
One of the measures that was introduced by the government in the deferred budget, the October budget, was a temporary loss carryback regime. So what it allows effectively is corporate tax entities, companies that have less than 5 billion in turnover, so a common threshold you will have seen from the temporary full expensing measure, that have earned losses in 2019-20 or a subsequent year up to 2022-23, which is a budget announced extension to these measures, allows those losses to be carried back and offset against profits in earlier years and effectively claim a refund of the tax that was paid, or at least part of the tax that was paid in those earlier years.
So essentially what you have is, if you have incurred losses or are incurring losses in a corporate entity, you can carry those losses back to prior years where you've paid a taxable income. One of the key limitations to this is the franking account balance, where you can't otherwise claim over and above what your franking account balance will be at the end of your income year. Now, this 30 June 2021 is the first year that you can make the claim for that. And one of the key items is that you need to claim that if you're not a SAP or lodging a part year tax return, you need to claim that in a tax return. So you need to lodge your tax return, which would be lodged after this 30 June. And so you'll be dependent on when that stationery becomes available. But one of the key advantages of doing loss carryback is that you can get access to the cash now, rather than trying to carry forward the losses in a future year and save income tax in a future year. Now, the way the provision does work, though, it does have a limitation with respect to being capped at the current tax rate. So you apply the corporate tax rate that applies to the company for this year, rather than what you paid tax for in a prior year. I'll move to the next slide. So just to demonstrate here, we have an example where we've got a loss being incurred and we've got a loss in the 2021 income year of 800,000, and the company here has in the 2021-22 year, sorry, of 800,000, and in that year it will have a 25% tax rate in that year. And it's demonstrating here that there's had some income in the prior years where it's been taxed at 26 and 30%. And in this example, what's happening is we're looking to carry back that tax loss to those earlier income years and claiming a rebate or tax offset for that amount of the 800,000 loss that is otherwise carried back to the 21 year of 80,000 and the 2020 year of 720,000. Again, applied at the tax rate that's applicable to the relevant income year. Now I'll move to the next slide, which leads into something that's quite important for corporate groups, and that's the tax rate that's applicable for this year and for next year. So for this year, if you have a company and it satisfies what we call the base rate entity rules, it could be subject to the lower rates of tax, which this year, this 30 June 2021, is 26%, and it's moving to 25% next year. And essentially what that requires you to have is turnover of less than 50 million, as well as having passive income of 80% or less. So you can move in and out of those rates of the higher rate, 30%, or the lower rate, depending on whether you meet those criteria for the income year. For franking looks at those conditions, but it looks at it in the prior year. So it looks at your prior year as to whether you otherwise meet those tests. And if in the prior year you had less than 50 million turnover or passive income of less than 80%, then, sorry, the slide's just disappeared. Thank you. Then you will apply a reduced franking rate potential of 26% for dividends paid this year. Now, just a critical thing, if you are planning on dividends up to 30 June this year, it's really important to understand your position for last year so that you don't underestimate or overestimate the amount of franking credits that you're attaching to your dividends. It's also important to note that you will lose 1% of your franking credits next year. So if you're paying tax at 26% this year and paying dividends next year at 25%, you'll lose 1%. If this year you're paying 30% tax and next year you think you'll be a base rate entity and you'll pay 25% in terms of franked dividends, then you'll lose 5% as a black hole. So it is an important consideration to understand where you are at any point in time, especially coming towards the 30 June end of income year. I'll move to the next slide. Thank you. Just one final point. As I mentioned earlier, we do have an ATO that is going to become more aggressive around trusts going forward, especially around tracing distributions, application to Division 7A, and we understand they're also looking at how to treat capital payments made out of trusts that we believe is going to become a future issue for trusts. So it is always opportune when you're coming to 30 June to think about your structure and try to see whether there are opportunities to restructure trusts into companies. There are possible rollovers where you can roll over assets in a trust into a company, which may not result in certain tax events happening. However, you'd have to think through your other considerations, such as commercial accounting, whether you have to lodge financial statements or have audits completed. Also, whether there's a stamp duty on any of those transactions and what it means for CGT discounts on a sale, whether you're able to sell shares later, and the small business concession consequences, etc. Something, though, to be thinking about, because the structure can be greatly simplified by having the profits in a company and dividends paid by the company to the trust to relevant individuals, otherwise where they may get access to refundable franking credits. I'll move to the next slide, thank you. And importantly, as I mentioned earlier, ATO is always focusing on Division 7A, and through the top 500, 5,000 and extended reviews, the questions the ATO will always pose is your compliance with Division 7A. They're asking for loan agreements, They ask for detailed transactions with all related parties. They're asking for your compliance otherwise on Division 7A. And they're also doing a lot of tracking and testing to tax returns and tax return disclosures around this and using their risk engines to identify risks around Division 7A. So it's a great time for you to consider your compliance with Division 7A, checking whether you've got loan agreements in place for all your entities that are valid agreements covering either payments or loans, whether you need to convert payments into loans for 30 June, the interest rate you're charging for 30 June, whether you've made minimum loan payments this year and whether you need to declare larger dividends before 30 June to make up for any shortfall of your minimum loan repayments, whether you need to put sub-trust agreements in place or make interest payments on your sub-trust arrangements as well. There's some watch outs within there, especially when you're putting in loan agreements. Please make sure you're not doubling up on loan agreements. A new loan agreement, there's a court case held that a new loan agreement replaced an old one and constituted a complete new reborrowing, which triggered deemed dividends, as because you're not allowed to refinance Division 7A loans under the provisions. So that's a key watch out under the provisions. Also, if you are repaying loans and you reborrow an amount straight after, that could also trigger the reborrowing rule that the ATO are definitely looking at. And one that's often missed is the interposed entity rules, where the company makes a loan or payment to interposed entity, which then makes a loan or payment to the target entity. And people aren't picking up that the ultimate lender, the company that's made that loan or payment, looks through the interposed entity for Division 7A purposes. So it is a critical one to look at. So Division 7A, really important issue. Great time for you to start your reviews, look at your compliance with that before 30 June. I'll pass back to Peter, who's back with us.
So just to note them, whilst there was nothing really in the budget other than the extension of the low and middle income tax offset for individuals for next year, so effectively no change in your tax rates from this year to next year. And you'll get a copy of these slides, so I won't spend too long on this one and the next one. So if we can move to the next one, please. So this slide is designed to identify the amount of the cash amount of a dividend, which, if fully franked at the relevant corporate tax rate, or more particularly corporate franking rate, can be paid to an individual without triggering a top-up tax liability for the individual shareholder. So obviously a lot of numbers in there. You'll get a copy of the slides, as I say, so maybe I can just leave that one to you to work through. And if you want to talk about that, then by all means contact one of us or your usual Pitcher Partners representative. So now that we're back working from home, at least for a couple of days, or at least for those that don't want to go into the office and wear a mask, the issue of working from home expenses is going to be popular again. So there's really three options that are allowed. One is full compliance with the income tax law, which means substantiation records, proving up deductions, etc. Or you can use one or other of the two shortcut methods that the tax office has allowed. The first, and it's been around for a long while, is what they refer to as the fixed rate method, which allows for a deduction at 52 cents per hour for each of the hours that you did work at home. Obviously requires a diary to be able to prove the hours worked from home. The 52 cents covers the utility costs and depreciation of any office furniture. So you cannot claim over and above the 52 cents for office furniture depreciation, but you can claim additionally for depreciation of computer equipment and any other office equipment that you might have as part of your working from home setup. The second shortcut method is what they refer to as the shortcut method. It's 80 cents per hour. It covers everything: utilities, office furniture, office equipment. And again, obviously, you'll need a diary to be able to substantiate the number of hours worked from home. Then a couple of comments about superannuation. Obviously, there is some advantage in maximising concessional contributions, which are deductible contributions, may be done through salary sacrifice arrangements, so it may not actually be something that you tip in personally. This year, the maximum is $25,000. From 1 July, the maximum is indexed to $27,500. So from next year, you can top in another 10% over and above what you could this year. For those that haven't been able to make the concessional contribution cap in prior years, there is the ability to bring forward the shortfall from those earlier years and to claim additional contributions over and above the current year cap, up to the amount of the shortfall from prior years. Only available though if the individual's total superannuation balance is less than $500,000. The other way in which it's possible to top up your superannuation balance is by way of what's referred to as non-concessional contributions, so non-deductible contributions. There's a maximum annual cap of $100,000, indexed from 1 July to $110,000, and the ability to bring forward 3 years worth of non-concessional contributions into 1 year. Now, wouldn't necessarily be doing that this year. If you did seek to do it this year, your cap would be 3 times $100,000, which is the current year cap. You don't get 100,000 for this year and 110 for what the cap will be next year and the year after. That cap only applies with effect from 1 July 2021. So if you're interested in non-concessional contributions to top up your superannuation fund, we'd be suggesting 100,000 is the maximum for this year. And then next year, look at a $330,000 bring forward non-concessional contribution if that's what you're interested to do. Just the other thing to note, the scheduled scheduled increase in the superannuation guarantee rate to 10% applies from 1 July. And obviously, as the government announced in the most recent budget, the 450 threshold before superannuation guarantee becomes payable is to be removed once enabling legislation passes Parliament. So those brief words about superannuation for individuals. So the next one, please. Just a word on areas of focus. Not really much new in this. The common areas that the tax office have focused on for individuals for a number of years. Work-related expenses has been a big one over the last few years following a GAP report. And one thing in particular that the tax office are focusing on for 2020 and 21 is people who are just cutting and pasting work-related expenses, particularly work-related travel expenses, given that for a large part of those 2 years, travel was restricted or at least constrained. Rental properties is a common area for the tax office. Holiday homes being rented out for less than commercial rental income and or full deductions being claimed for the costs of or related to the rental property. More generally, rental properties, we talked about some limitations on deductions earlier, so be mindful of those recent legislative changes that constrain rental property deductions. More generally, although it also can apply to rental property deductions, to the extent to which loans used to acquire a rental property are also used for other purposes, in particular for private purposes, need to make sure that interest deductions relevant to the private portion are not claimed. Data matching is something that's become big with the tax office over recent years, and you will have seen this in information that's pre-filled for use by tax agents in completing individual tax returns. You will have seen that property transactions have been picked up for a couple of years. Share transactions have been picked up for a couple of years. Recently, the tax office has said that they are working on data matching with cryptocurrency exchanges. So if you've been lucky or unlucky enough to win in that space, then make sure you're reflecting it appropriately in your income tax returns. The registration issue is really a plus and a minus. If you wish to maintain your GST and ABN registrations, then you expect, if it hasn't been actively used for a couple of years, expect at least a letter from the tax office saying, we note you haven't been active. Is it appropriate to cancel these registrations? And you'll need to substantiate why they need to be retained if that's what you wish to do. Alternatively, provides you with the opportunity to cancel them and do away with the reporting obligations that they may otherwise raise.
So that brings us to the end of our session. before I go into some just questions that have been raised. But leave you with this slide, which in jest refers to some children selling lemonade and deferring their income by getting paid in a subsequent income year. But in looking at these types of issues, this type of thing that the ATO have commented on, in their view, doesn't result in tax planning. They've put out various statements saying that deferring of invoices doesn't necessarily defer your income. So the key thing is we do put out a guide on year-end planning that talks about legitimate tax planning opportunities and ways that you may be otherwise be able to change your taxable income using legitimate means. So just something to keep in mind, and stay tuned to the year-end guide that will be released next week, which will cover other potential opportunities. Now, so we had one question, and it was essentially whether the full expensing of assets rules applies to the car threshold limit. I think the question referred to the 57K limit. The answer is yes. You can only deduct the total of the car limit, which I believe is $59,136 for the 30 June 21 income year. And you just got to be mindful that if there is any non-business use with respect to the vehicle, that you would need to adjust your claim for that. And otherwise, you would need to meet all the criteria for otherwise claiming the full expensing amount. I believe that was the only question that we received from the audience. So with that, we'll look to close the session. I want to thank everyone for attending this session on year-end planning. As I mentioned, if you have any questions, please feel free to direct them to us. Please feel free to contact your normal Pitcher Partners advisor. Look out for our year-end planning guide, which will be released so that you can go through that for year-end. If you don't receive an email in respect of that, feel free to contact either myself or Peter, and we can get you a copy of that as well. Please note that we'll have a lot of information around year-end planning on our website, so please make sure you check out our website for any other bulletins and other information that may be relevant to you. And please, we will have this presentation on our YouTube channel, and please check out any of our other content our past content that is also contained on our YouTube channel as well. So with that, I'd like to thank you for your attendance and wish you all the best in your year-end planning. Thank you.